Hello everyone, I'm Yazan Ibrahim, or as some of you might know me, Yazan Abu Ghosh. Today we're going to dive into a fascinating and essential topic, Fraud Examiners Section 1, Financial Transactions and Fraud Schemes. Welcome to today's deep dive into Financial Statement Fraud. What is financial statement fraud? The cost of financial statement fraud. Why financial statement fraud is committed. Trends in financial statement. Financial statement, fraud schemes. What red flags are associated with financial statement fraud in general? Detection of fraudulent financial statement schemes, financial statement analysis, interviews in fraudulent financial statement cases. Whether you're an aspiring fraud investigator, a business owner, or simply curious about how organizations manage their finances, or if you are auditor, this journey will shed light on the often complex systems that drive decision making. Now, what is financial statement fraud? The cost of financial statement fraud. Why financial statement fraud is committed. Trends in financial statement fraud. Financial statement fraud is like the dark underbelly of corporate reporting, a deliberate act of manipulating a company's financial condition through the misrepresentation or omission of details in financial documents. To truly understand this topic, we need to take a step back and examine the broader category it belongs to: occupational fraud. This is any misuse of an organization's resources by someone entrusted with its management, whether an employee, manager, officer, or owner. Think of it as a fraud tree. At its core are three branches: asset misappropriation, like stealing funds, corruption, such as bribery, and financial statement fraud, the focus of our discussion today. Let's begin by defining financial statement fraud. It isn't just an honest accounting error, no, the key is intent. As outlined by auditing standards, fraud involves intentional actions, whereas errors stem from honest mistakes. Financial statement fraud isn't the goal itself. It's a tool employed for other motives, a means to manipulate the perception of a company's financial health. People cook the books for various reasons: to skirt compliance requirements, to attract outside financing, or sometimes to inflate profits for personal benefits like stock dividends or performance-based bonuses. On other occasions, it may even serve to preserve a leader's status or job security when the company's real financial status might threaten their position. But how does it manifest? Most commonly, perpetrators overstate assets and profits or understate liabilities and losses. Imagine a scenario where a company glosses over a financial loss to sprinkle on a sheen of success. The purpose might be to ward off shareholders' panic. Conversely, some even understate income to reduce taxes in profitable years. These actions aren't just isolated flourishes on paper, they have deep and far-reaching implications. The culprits? Financial statement fraud often originates at the top, committed by high-ranking executives like CEOs. Why? Because they hold the reins of decision-making and the organizational power to manipulate the books. Their dual motives, protecting their image and preserving authority, often drive such actions. What makes matters worse is that fraud tends to persist undetected for long periods, as those responsible for oversight often fail to act effectively. And the cost of this fraud is colossal. It isn't just numbers on paper or balance sheet edits, it can devastate an organization. Entire companies collapse under the pressure. Overnight, billions of dollars can vanish in lost stock market capitalization, taking the trust of investors and employees with it. Jobs are lost, retirement funds are obliterated, even the auditors can become ensnared in lawsuits. Financial statement fraud, though the least common among occupational fraud categories, causes the greatest monetary damage on average. The median cost? A staggering $800,000, though the ripple effects often leave much larger losses in their wake. So why do they do it? The underlying drivers of such fraud can be explained through the fraud triangle. Three crucial factors that spell danger when they intersect: situational pressures, opportunity, and rationalization. Situational pressures might include an industry-wide downturn or mounting financial obligations. Opportunities arise from weak controls, like the absence of an audit committee or inadequate oversight. And then there's rationalization, where perpetrators justify their crimes by twisting logic to protect their conscience. For example, they might tell themselves, "We'll just fix this next quarter," or "understating revenue this year saves us taxes. It's good for the company." These subtle shifts in thinking highlight just how psychological fraud can be. To detect early warning signs, red flags, we must consider factors like unrealistic revenue projections, weak internal controls, and complex or unusual transactions. Often, just the perception that a fraud will be detected acts as a deterrent. However, without proper internal audits and external oversight, opportunities to commit fraud expand. Companies must stay vigilant because while red flags can often foreshadow problems, unchecked behavior allows even small misdeeds to snowball into devastating scandals. To conclude, financial statement fraud might appear as just another chapter in accounting ethics, but its real-world repercussions far exceed theoretical boundaries. It crushes employee livelihoods, decimates investor trust, and in extreme cases, topples entire corporations. By understanding its causes, recognizing the warning signs, and enforcing meaningful preventative measures, organizations can safeguard their reputations and fend off potentially catastrophic consequences. Because in the world of finance, the truth is not just an obligation, it's the foundation upon which everything else stands. Financial statement fraud schemes. The world of financial statement fraud is a complex and often deceptive landscape where companies manipulate their records to present a distorted reality. Through schemes such as fictitious revenues, timing differences, and improper asset valuations, companies craft illusions of financial health, misleading investors, creditors, and regulators. Let's dive into this murky territory, examining its various facets and infamous cases to understand how these fraudulent practices unfold. To begin, financial statement fraud generally takes two forms: overstating assets or revenue and understating liabilities or expenses. Imagine a company painting a brighter picture of its finances by inflating its earnings, like falsely recording sales that never happened, or ignoring costs they know they must pay, making their equity reserves appear lush and prosperous. Conversely, some entities orchestrate the opposite, intentionally minimizing assets and revenue or exaggerating their liabilities to mislead stakeholders about losses, taxes, or other factors. Now, these aren't isolated acts of deception. Fraudulent records always affect at least two areas in financial statements, as maintaining such records relies on a double entry bookkeeping system. For instance, a fabricated sale might falsely increase revenue, but it also has to reflect adjustments in accounts like assets, for example, accounts receivable. This dual impact enables fraudsters to orchestrate larger schemes under the facade of legitimacy. These schemes typically fall under five classifications: fictitious revenues, timing differences, concealed liabilities and expenses, improper asset valuations, and improper disclosures. A tale of strategic manipulation, the Bally Total Fitness case. The scandal involving Bally Total Fitness Holding Corporation offers an illustrative example of multiple overlapping fraud tactics. From 1997 to 2003, Bally engaged in more than 24 accounting violations, grossly misstating its financial health. By the time its fraudulent activities came to light, the company had overstated shareholder equity by $1.80 billion, an astronomical 340%, and understated net losses by millions over consecutive years. These manipulations give us insight into the extent of damage financial fraud can wreak on stakeholders' trust and confidence. What exactly did Bally do? At its core, the company used timing tricks to inflate revenues and disguise expenses. For example, Bally prematurely recognized revenue by accounting for prepaid membership dues immediately upon receipt instead of spreading it over the actual membership period, aligning with customers' usage of services. Similarly, it fabricated revenue streams by using hypothetical fees or exploiting membership reactivation payments that hadn't yet occurred. These practices violated the revenue recognition principles of US Generally Accepted Accounting Principles GAAP, which dictate that earnings should only be recorded when they are truly earned. In another move, Bally counted unpaid dues from inactive members as revenue, further distorting its earnings. Each of these violations allowed Bally to give the illusion of stronger financial outcomes than reality could support. Expense manipulation went hand in glove with revenue inflation. Bally deferred costs, advertising production expenses, interest liabilities, or even employee compensation during temporary club closures that should have been expensed immediately. Such deferrals created a mirage of profitability or reduced losses within specific periods. Further, the misrepresentation of leases, tenant allowances, and goodwill overstatements added another layer of deception, hiding expenses, or inflating assets to maintain this faulty facade. Fictitious revenues, the art of creating wealth out of thin air. In fraudulent schemes, there's a particularly audacious technique used by unscrupulous entities: fictitious revenues. Imagine a business manufacturing non-existent sales, like drafting fake invoices for legitimate customers without delivering goods or services. Perhaps those invoices never even reach the customers, existing purely to pad figures when reporting to shareholders. At year's end, fraudsters might reverse the entries to cover their tracks, but by then, the inflated numbers will have already served their purpose. However, this can create a snowball effect, leading to a shortfall in future revenues, which invites more fraudulent activity to plug the gaps. Recording such revenues requires inventiveness to ensure both sides of transactions align in the records. Companies often increase accounts receivable to match the revenue spike, portraying it as payments anticipated from customers. The scheme can unravel, though, when these receivables linger unpaid and suspiciously overdue, eventually necessitating expensive write-offs. Such signals, ballooning bad debt expenses or unduly high outstanding accounts, can be warning indicators of fraud. One infamous case of revenue fabrication took place at Satyam Computer Services Limited, often called India's Enron. Satyam's management falsified figures for years, overstating revenues and cash balances by more than $1 billion, over half the company's total assets. With over 6,000 phantom invoices for fake customers and services unperformed, Satyam's records misled stakeholders into believing in its impressive growth. Senior managers even forged bank statements to mask these non-existent revenues, going as far as creating fake confirmation documents during audits. This elaborate fraud unraveled in 2009 when the company's chairman confessed, leading to one of India's largest corporate scandals. Lessons from the fraud playbook. What these cases, like Bali and Satyam, highlight isn't just how financial fraud is executed, but also how the illusion is sustained. Both exploited systemic weaknesses, such as inadequate internal controls or complicit auditors, to prolong the deception. With auditors either negligent or actively ignoring red flags, these companies thrived in their deceit until the facade crumbled. Counteracting such fraud requires diligence, robust auditing practices, and regulatory oversight. Accounting standards like US GAAP and frameworks like Sarbanes-Oxley, SOX, exist to close loopholes and clearly define proper practices. But human greed often finds or creates new cracks to exploit. This means stakeholders and regulators must remain vigilant, recognizing the red flags of fraudulent practices, whether it's receivables that never age off the books or implausible year-over-year growth patterns. Financial statement fraud may seem dull on the surface, buried in the technicalities of accounting, but its impact is seismic. It erodes trust, undermines economies, and destroys livelihoods. By unpacking and understanding these schemes, from timing tricks to outright fabrications, we can arm ourselves with the knowledge to recognize wrongdoing before it wreaks havoc. In the end, integrity in accounting is more than a regulatory requirement. It's essential to fair and transparent commerce. Detection of fraudulent financial statement schemes, financial statement analysis, interviews in fraudulent financial statement cases. What comes to mind when you hear the term financial fraud? Imagine a trusted paymaster working for years in a medium-sized company, suddenly buying a flashy new BMW and indulging in luxurious vacations. It raises questions, doesn't it? That's exactly what happened at Jackson Hardware Supply, a plumbing and electrical wholesale distributor. This seemingly ordinary company became the stage for our financial drama, a story of misappropriated funds and calculated deceit. The scene, a closer look at the numbers. On the surface, Jackson Hardware's financials appear healthy. Their balance sheet reflects a perfect equilibrium, assets equal liabilities and owner's equity at a total of $3,522,000. The income statement boasts a net income of $664,000 for the year, driven by sales revenue of $3,470,000. A financial fairy tale, right? Not exactly. An anonymous tip regarding the paymaster sparks suspicion. The company president hires a fraud examiner with a straightforward mission: uncover any misconduct. Their suspicion grows as they dig deeper, starting with the salary expense account, the most obvious suspect when excess payments arise. Here's a twist. Last year, Jackson's total salary expense was $180,000. This year it jumped to $220,000, despite no increase in workforce size or significant raises beyond a modest 10%. A quick recalculation reveals the salary expense should only be $198,000. $180,000 x 1.10. Where did the extra $22,000 go? The numbers don't lie, and they're hinting at a deeper scheme. Tracing the trail from statements to source. To unravel the mystery, an analytical journey unfolds. The fraud examiner meticulously traces the overstatement in salary expenses from the income statement through the accounts, journal entries, and ultimately to the source documents. The smoking gun? Payroll checks. Among these, 12 checks payable to John Doe, a former employee who left in January last year, are discovered. Adding to the intrigue, the endorsement signatures on these checks are eerily similar to those on the paymaster's own checks. Confronted with this evidence, the paymaster confesses to embezzling $22,000 by issuing checks to a non-existent employee before cashing them. Detective tools, fraud detection through analysis. While this example highlights the importance of scrutinizing salary accounts, it's just the beginning. Detecting fraud often relies on advanced financial statement analysis methods, vertical, horizontal, and ratio analysis. Let's break these down. Vertical analysis. Picture. A magnifying glass hovering over a single financial statement. Vertical analysis focuses on the relationships between line items within that one period. Every number is expressed as a percentage of a base figure, like how individual income statement figures are calculated as percentages of total sales. This method simplifies comparisons between companies of differing sizes by creating a standardized format referred to as common sizing. For example, sales might equate to 100% of revenue, while general expenses make up 20%. Any inconsistencies or deviations from historical norms, like costs making sudden unexplained jumps, trigger a closer review for potential red flags. Horizontal analysis. Now, imagine a timeline of financial performance over several periods. Horizontal analysis compares the movement of line items year over year, calculating changes as percentages. For example, if sales revenue skyrocketed by 80%, while cost of goods sold, COGS, increased an even more extreme 140%, questions should arise. Could it be that some fraudulent expenses are hiding within the inflated COGS? Such irregularities prompt investigators to dig into the underlying source documents. Ratio analysis. Ratios provide powerful insights into a company's liquidity, efficiency, or profitability. For example, the current ratio, current assets and current liabilities, reveals whether a company can meet short-term obligations. A suspiciously low ratio might signal embezzlement, as cash, part of current assets, could be siphoned away. Conversely, manipulating liabilities might falsely inflate this ratio to give a positive impression. Monitoring these ratios for sharp declines or unexplained shifts is another effective tool for fraud detection. A broader view, uncovering patterns in the chaos building. On these techniques, the video introduces the transformative power of viewing all three analyses together. For example, if accounts payable jump significantly as a percentage of liabilities during vertical analysis, and the horizontal growth far outpaces historical averages, it signals a crucial question. Is something hiding in these accounts? By examining ratios alongside these changes, auditors can pinpoint concealed schemes like overstated expenses or fabricated vendor payments. The lesson? All numbers must align to tell one cohesive story. When they don't, it's a sign to look deeper. Wrapping up, knowledge as the ultimate defense. As we wrap up, it's clear that financial fraud schemes might seem complex, but uncovering them comes down to understanding basic accounting concepts and having the persistence to follow the breadcrumbs. Whether it's tracing payroll discrepancies, analyzing unusual changes year over year, or spotting outliers in financial ratios, the tools are there for those who know where to look. In our video, the audience will walk away not just with a deeper understanding of financial fraud, but also inspired by the techniques used to expose it. They'll learn to view financial statements through an investigative lens, find meaning in numbers, and realize that behind every fraudulent entry lies a story waiting to be told. This is more than an educational video. It's a journey, a tour inside the world of financial sleuths, tasked with unraveling schemes hidden beneath layers of numbers. Let's inspire curiosity and sharpen the instincts of potential fraud examiners, accountants, and even everyday business owners. Fraud schemes thrive on complacency, but knowledge and keen observation can outwit even the most cunning perpetrators. Thank you for watching, and as always, continue learning. Stay curious, and we'll see you next video.